You're not losing homes to avocado toast. You're losing them to three financial giants that treat houses like profit machines. If you've been outbid, priced out, or told to wait it out, stop. There's a smarter path. Today, I'll show you who you're competing against, why their edge works, and the counter-playbook to beat them. You'll leave with 3 house hack targets, hard stats, and headlines to guide your search, a simple underwriting checklist, and a duplex ROI spreadsheet. And there's a fast close tactic that puts you nearly on par with cash offers coming up. First, know your opponent so you can pick the right move. Giant 1. Institutional investors. In many markets, investors buy a large share of homes. National reporting has shown investor purchases hovering around roughly a quarter of transactions in recent years, including big landlords that own tens of thousands of units. Here's why that hits you. They favor turnkey, single-family homes in certain zip codes, move fast with streamlined underwriting, and accept thin yields because they're playing a long game on rents and appreciation. The result is tighter inventory, fewer starter homes, and faster rent growth, so entry-level buyers face steeper prices and intense bidding. Giant 2. Restrictive zoning and slow approvals. When cities lock most land into low-density, single-family-only zones and delay permits, supply lags demand. Builders then focus on higher-margin, luxury projects, because if it takes years and heavy fees to build, you aim upscale. That pushes price-to-income ratios higher across many metros and drains the pipeline of affordable new homes. Headlines keep flagging this. Shrinking shares of affordable new single-family homes since 2020 and stalled projects due to red tape show up again and again. Giant 3. Short-term rentals pulling units from long-term housing. In tourism-heavy areas, conversions into short stays can reduce local supply for residents. That's why you're seeing local pushback and tighter rules in some cities. The impact varies by market, but in the wrong neighborhood, this shift squeezes renters and first-time buyers by soaking up what would have been entry-level rentals or starter homes. Here's the point. Their edge is concentrated. Institutions chase easy-to-manage, turnkey single-family assets. Zoning and permitting choke dense, affordable options. STR cluster in specific, high-visitor pockets. Your best chance is where their playbook is weak, unloved inventory, and small multifamily. Target 1. Small multifamily duplex, triplex, and quad in solid B or C class neighborhoods. Why this works. Big funds often ignore 2 to 4 unit properties, yet the rent-to-price ratio is typically stronger than single-family. As an owner-occupant, you may access favorable loan programs, and your tenants help pay the note. What to look for. Separate utilities per unit if possible, basic finishes you won't feel bad replacing, and stable rental comps within a half mile. Ask for recent roof and HVAC ages, and walk basements and crawl spaces carefully. The thing most people miss is structural risk. Foundation movement and major mechanicals can nuke your returns. How to run it. Live in one unit, rent the others on 12-month leases, and run conservative numbers. Use a vacancy assumption that matches local data. Budget repair and maintenance plus capital services, and stress test your interest rate. Quick win today. Shortlist 3 duplexes with separate meters and price to rent better than nearby single-family comps. Target 2. The unsexy, fixer-light single-family with an ADU or bonus space potential. Why this works. Institutions prefer turnkey. White Rehab lets you create equity fast and add income with a legal accessory unit or a rentable suite. You get yield without a gut job. What to look for: cosmetic updates over structural work, simple mechanicals, and zoning that allows ADUs or junior ADUs. Confirm parking compliance and utility access. Here's the catch: local ADU rules vary widely, so check setbacks, owner occupancy requirements, and permit timelines before you buy. How to run it: plan a 90-day, scope-limited rehab. Paint, floors, fixtures, maybe a kitchen refresh. Set a cap on spend and timeline. Use rent by room or ADU comps to estimate income and aim to cover a meaningful chunk of PITI. Quick win: call your planning department and download the ADU checklist for your parcel type. Target 3: up-and-coming edges near job nodes or transit. Why this works: these areas sit just outside hot cores, with rising rent demand and better yield before headlines catch up. You're banking on real drivers, new employers, school or hospital expansions, or planned transit improvements. What to look for: announced public investment, employer moves, hospital or university growth, and days on market above the city median. That last one gives you leverage. The game changer nobody talks about is negotiating seller credits to buy down your rate when DOM is higher. How to run it: set rent targets tied to local median incomes, not wishful thinking. Negotiate credits, stay flexible on close dates. Use conservative appreciation and realistic rent growth. Common mistakes to avoid across all targets: over-rehabbing, underestimating maintenance, ignoring STR ADU rules, and skipping reserves. Hard stats and headlines to guide you. National investor share has been reported near 1 in 4 purchases in recent years. The share of affordable new single-family homes has dropped since 2020 in many regions, and several cities have tightened short-term rental rules. Use your local feeds to pull investor share by zip, months of inventory, and year-over-year rent growth. If this is useful, tap like so I know to cover more. Now you need speed and clean numbers. The fast close tactic is getting pre-underwritten, not just pre-approved. Here's why. It lets you shorten contingencies, show the seller your lender already vetted you, and makes your offer feel close to cash. Most people stop at a basic letter. You'll go further. How to do it: ask your lender for full doc review and a desktop underwrite. That means they clear your credit, income, and assets before you shop. What you'll bring: 2 years of W-2s or tax returns, your recent pay stubs, 2 months of bank statements, an ID, and any gift letters. Get it done before the first showing so you can move when a deal appears. Offer mechanics that beat giants. Keep an inspection window short, 5 to 7 days, with the right to cancel for any reason in that period. Cap your appraisal gap by a dollar amount you're comfortable with, not a blank check. Ask for seller credits to buy down your rate if days on market are above median. Attach proof of funds for your down payment and the lender's DU findings to your offer. Stay flexible on close date to match the seller's move-out needs. Let's talk duplex ROI math. Open your spreadsheet and load the core inputs: purchase price, interest rate, down payment, property taxes, insurance, HOA if any, rent per unit or room, vacancy rate, repairs, capital expenditures, and management. Even if you plan to self-manage, include a line. The outputs you want: monthly PITI, net operating income, debt service coverage ratio, NOI divided by your mortgage payment, cash-on-cash return, and break-even rent. Here's the rule set I want you to use. The 1% rent-to-price ratio is rare in many markets right now, so don't chase unicorns. Aim for a DSCR of at least 1.15 at today's rates when you include realistic vacancy and reserves. Your cash-on-cash should be positive after you set aside money for repairs and capital items. If it's negative, you need a lower price, higher rents supported by comps, or seller credits to cut your payment. Underwriting checklist. Quick pass or fail. Income. W-2 or 2-year self-employed history. Understand how your program treats rental income. Many lenders use a fraction of projected rent or require a lease. Keep your debt to income near or under 43%, noting it's lender dependent. Property. Must be habitable, with no major foundation issues. Separate meters are preferred. Ask ages for roof and HVAC. Old systems hit cash flow. Reserves. Stack 3 to 6 months of PITI. Some programs require more per extra unit. Action sprint for the next 7 days. Day 1 and 2. Get pre-underwritten and gather every dot. Load the spreadsheet template. Day 3. Shortlist 12 properties across your 3 targets. Day 4 and 5. Do showings and comps, plug numbers, and cut losers fast. Day 6 and 7. Write offers on your top 2 or 3 with fast close terms and clear caps on risk. Once you have this system, you can rinse and repeat with discipline. You won't outbid the giants, but you can outsmart them by hitting small multis, fixer-light ADU plays, and edge neighborhoods with a pre-underwritten file and tight numbers. Download the Duplex ROI spreadsheet and the underwriting checklist linked below. Subscribe for weekly, practical finance tips and smarter paths to your first home.